Okay, so moving forward with the Luca-Pacioli's principle, these are some of the specifics we can talk about. Okay, so let me create a table here, and I'll make my professors appreciate. Okay, so you all appreciate that we've gone through asset, liabilities, capital, and I also added expenses and income. So let's get these elements of accounting. So elements, the element of accounting. So we have assets, and you see the assets and expenses behave, or they have similar behavior, right? And then capital, liability, and then income. They also have same behavior. So their behavior is dependent upon whether there is an increase in it or there is a decrease. So please note this carefully. According to the double entry principle or Luca-Pacioli's principle, if assets or expenses increase, professors, we make a debit entry. We make a debit entry. When assets or expenses increase, we make a debit entry in their account. When they decrease, we make a credit entry. On the flip side, when capital, liability, or income increase, we credit. And when they decrease, we debit. So just making a quick illustration for you to appreciate this. Let me erase this. If, for example, we have, say, an office furniture, like the example we saw, where the business bought office equipment. Then when you open the office equipment account, permit me to use E for equipment, okay? When you open the office equipment account like this, we saw in that transaction that the office equipment increased because the business had bought office equipment, right? So when office equipment increase, what are you supposed to do? You have to debit that account, meaning that you have to come to the left side and put the entry there. Now, what entry do you put there? Normally, you pick the date of the transaction, the amount involved in the transaction, and other particulars or details, which I'll tell you about when we begin examples. So, dear professors, know that when assets increase, we debit. When they decrease, we credit. When capital, liability, or income increase, we credit. When they decrease, we debit. If we are comfortable with this, then let me take us back to our table for this transaction that we saw. And I want to test my professor's understanding here. So dear professors, you all appreciate that in the first transaction, which was sold goods and the money banked, we also saw that there was a decrease in asset stock and increase in asset bank. Now my question is, based on what we've discussed, that when asset increase, you debit, when they decrease, you credit, what would we have done in transaction 1? Which account would we debit and which account would we credit? Okay, I think Portia is ready. I want more hands. I want more hands. Otherwise, it means that some of you haven't gotten the concept. So, Portia, hold on for me. Let me get. Okay, I have two now. Eugenia, Zoe, Emmanuel, Bridget, Austin. Oh, yes, I'm having just two out of about 10 students. That's not encouraging at all. I want more hands. Even if you are not sure, I want to hear your not sure. Okay, let me allow the ladies who have their hands up to talk, then I'll come to others. So, Prof. Portia, go first.
Sir, please, the rule is debits the giver and credits the receiver. Or say, have I changed it?
Well, that rule you just mentioned is an application of the principle. It's not entirely the principle. Okay.
Okay. So we debit the okay. So first, so we debit the goods, that's the purchases. Then we credit the bank money.
Are you sure? Because let me take you back to the principle we've just discussed. And the principle is that when assets increase, you debit. When they decrease, you credit, right? And then on the table here, point number 1, we have decrease in asset stock and increase in asset bank. So I'm asking again, which one will be debited and which one will be credited?
Say, please, goods will be debited and bank will be credited. No, say goods will be credited and bank will be debited.
Okay, so I think Prof. Portia is combining thoughts there. But I think the final submission is accurate, right? Josephine?
Sir.
Yes, please add your voice.
Sir, increase in assets bank will be debited and decrease in assets stock will be credited.
Okay. Thank you. Any other thought from other professors? Abubakar, Austin, Bridget, Emmanuel, Eugenia, and so.
Sir, please, I don't quite understand this debit and credit thing.
I'm happy you are coming up with that. I'm very happy. Okay. Yes, Augustine.
Sir, please, same. I also don't understand.
Okay. Let me get more reactions. So I've heard from Eugenia and Augustine, Abubakar, Zoe, Emmanuel, Bridget, Austin, and then Oswell. Your silence would not be so much appreciated. Please share your view. Let me know what's up with you. Yeah, Oswald.
Yes, I also don't understand.
Great. That's a good response. Okay, so let me take this whole thing again. Now, you all appreciate that businesses engage in transaction. And when we say transaction, it means any activity that has monetary element. There's money in it. So you all appreciated when we're looking at examples of transaction. Bought goods, maybe 100,000 cash. Okay. Now, what we are trying to do is to record this transaction in the accounting way. Right? And I'm telling you that in accounting, for you to be able to record these events or these transactions, you need to know the double entry principle. But prior to that, you need to appreciate how the transactions affect your assets, liabilities, and capital. That is why I was stressing that if you didn't understand the increase, decrease bit that we saw last week, you're going to have challenges here. Okay, so most of the time I try to make it more, relevant to your daily experiences. So I use the example like, let's say you are in a family, right? And then your father goes to buy a car. So if the family is a business, the business has gone to buy a car. Maybe daddy paid cash of 100,000. What it means is that your business will get a car. So there will be increase in car in your business. And the family or the business is also going to lose money, cash. Now, technically, the car is an asset. The cash is also an asset. So the effect we can conclusively say is that there is an increase in asset car and there is also a decrease in asset cash. Now, let me use another example. So let's say Eugenia or Oswald or Austin, you take yourself as a business and then you use 100 Ghana cedis to buy a bag from Melco. So you, Augustine, as a business, if you are looking at the impact this transaction has on you, you said, okay, you are getting a bag and you are also losing money. The bag is an asset. The money is also an asset. So in effect, you are increasing your asset in the form of bag and you're also decreasing your asset in the form of cash. Do you understand these examples I've just listed?
Yes, please.
Okay, I have a yes from Portia. I want to hear from Oswell, Augustine, and Eugenia.
Yes, sir.
Okay. So if you understand these simple things, then now the onus lies on you to get the 11 transactions I discussed with you. Okay, the 11 transactions, and let me go back to them. I took you through 11 transactions. Okay, making you appreciate what each of these transactions does to the assets, liabilities, and capital of the business. So we saw investment by owner, sale of goods, purchase of goods, and all the others. So please, if you miss the point there, you have to go back and watch the video. Right. After you have understood the increase and decrease effect of these 10 transactions, then I'm now bringing on additional concept which says that when assets increase, you debit. When they decrease, you do what? You credit. What is the meaning of this debit and credit? And I'm telling you that we'll be using an account to record or do this debit and credit. And this is how the account looks like. The account looks like a T. So let me draw the T here. So the account looks like a T, like this. So normally you have the name of the account or the title here. Okay. So if it is land, you write land. If it is building, building. If it is cash, you write cash. And I'm indicating to you that this side, which is the left side, is the debit side. And this side, which is the left side, the right side, is the credit side. So when we say debit an asset, it means come and record it at the left side. And when we say credit an asset, it means record it where? At the right side. And what are you recording? You are only picking the date the transaction occurred, the amount involved, and other particulars. So the things I want you to remember is that, number one, there's a certain principle we have to use to record transactions. And that principle is the double entry principle. What does that principle state? That principle states that when a transaction occurs, you debit and do a corresponding credit, or vice versa. So let me go to that point for you. Okay. So when a transaction occurs, you debit and there should be a corresponding credit. And I think now you appreciate what a debit is. A debit is you recording on the left side of an account, and the credit is you recording on the right side of an account. So what I was trying to do again is to now take us back. Okay, take us back to the transactions that we ourselves went through to see the effect, the increase, the decrease, right? And I wanted us to apply what we have just learned, that if assets increase, you debit. When they decrease, you do what? You credit. And I want us to apply on this one, on these transactions, that in the first transaction, we all analyze and realize that this transaction will lead to, one, a decrease in assets, as you see here, okay? A decrease in assets and a corresponding increase in asset bank. So my question was, based on the principle, which account would you debit and which account would you credit? And my professors answered that for the decrease in assets, we will do what? We will credit. And for the increase in assets, we will debit. That's all that I want you to tell me. So if we look at the second transaction, you see decrease in what? Asset. And my question will be, when an asset is decreasing, what do? You credit. And you have decrease in liability. When a liability is decreasing, what do? I think I need that answer from any of you. When a liability is decreasing, do you debit or credit? Yeah, Joseph.
Sir, please, you debit.
Okay, you debit. So I want my professors, all of you, Zoe, Abubakar, Austin, Bridget, to note these points, that when an asset increases, you debit. When it decreases, you credit. On the other hand, if capital or liability or income also increase, we credit. When they decrease, we debit. Because you'll be applying this to be able to record your transactions. Okay, because before you record your transaction, you need to do these analysis and see whether asset is increasing or is decreasing, like we did. So now let me find out from my professors if they are a bit okay. I know they will not be 100% okay, but if they are a bit okay so far as to what we were discussed and they are not totally lost. So Prof. Oswell, is it okay a little now?
Yes, please.
Okay. And Eugenia?
Yes, sir.
Is it okay?
Yes, please.
Okay. So if it is okay, then let me ask a question now to the both of you. So if somebody asks you that in accounting, when assets increase, what entry do you make? Do you make a debit or credit? What would be your answer? Okay, also go ahead.
Please, a debit. Debit.
Thank you. Thank you very much. Thank you. When assets increase, we debit. Thank you. So I want you to remember that principle. Remember it. When assets increase, we debit. When they decrease, we credit. When liabilities increase, we credit. When they decrease, we debit. So please, I don't know if any of us can compose a music or something to make us remember. Okay. If we have a musician here, a musician, yeah, who can compose something for us so that we can remember. When assets increase, we debit. When they decrease, we credit. And I think if you get that one, you can even know for the liability capital income, right? Okay. I think I'll leave it out for you in terms of composing. Okay. So now let me move a bit further by trying to apply what we have discussed. But I want my professors to appreciate the account further. So let me see if I can show you the account and how it looks like. So professors, as I indicated to you, this is the account, right? So you have the title of the account, and the title of the account is simply the asset or liability or capital that we spoke about. But for the asset, you can have example like maybe a land, an equipment. Okay. Now, stock as an example, we don't specifically have a stock account. Okay, the stock accounts are represented by either purchases account, sales account, return inwards account, and return outwards account. I think I'll speak more about that when we continue. Okay. But you can have the cash account, the bank account, and then the debtors. If the name of the debtor is given, then the name of that debtor will be the title of account. So maybe Kofi account. If it's a creditor or a supplier to you have Kwame or maybe XY Limited, right? That will be the title of the account. And as I indicated to you, the left side is the debit side and the credit side is the right side. So if you see in the double entry that you are supposed to make a debit entry, it means you have to record it on the left side, right? And I told you that the details that you need there to record are normally the date the transaction occurred. Okay, so as you see the date here, so is it 1st January 2025 or 25th April? The date is the first one. The other thing you need is the details or particulars. Normally, it is the name of the corresponding account. Because as you know, the double entry says when you debit here, there should be a corresponding credit here, right? So the example I gave for you as a business, if you buy a bag with cash, then the two accounts will be your bag account and your cash account. So when you go into your bag account, the particulars there will be the corresponding account, which is the cash. Likewise, when you go to the cash account, the particulars or details there will be your bag, right? So it's the date, the particulars, and then the amount involved, 100 cedis, 2,000, whatever. So these are the key information that we report. So this is how they appear in the account. So like I said, the name or the title will be up, and then on each of the sides. So on the left side, you have your date, the details, and amount. Please, I'll speak about this folio later, but we don't normally work on the folio in our studies as students. But in professional practice, you would have to use it. So I'll speak to you about it. So on each side, you have the date, the details, and amount. Okay, and when the transaction occurs, you pick those details. Okay, so dear professor, I believe now you are getting things small. It's not a magical event or like just boom, you understand everything. It's going to be gradual. But again, when you are confused, speak out so that your confusion will be cleared. I believe we are all comfortable now.
Yes, please.
Okay. So like I indicated, you will go back to the 10 transactions. Okay. But please, I want my professors to really remember, when we're dealing with this increase in asset, decrease in, okay, this 11, please remember the effects for me. If for some reason you don't have them, please go and watch the videos on the effects of transaction on asset, capital, liabilities. Because that will be used to eventually do the debit and credit. So if you don't understand, it will be a bit chaotic for you. So let's meet in the final or last session and see if we can start recording transactions in the T account as I've shown you, right? Okay, before I go, I think there are some messages in the chat. Let me see. Okay. Sure. Okay. Okay, somebody. Okay, debit and not debt. So thanks for that correction. Okay, so professors, let's meet in the last session.